However, it may not pertain to you because your situation might be very different from what I am going to be presenting today. So in order for you to take any kind of tax position on your tax return, you must have a written statement from me, basically letting you know that, yes, based on your personal circumstance, you may use this tax strategy specifically designed for you with your own circumstance in mind, okay?
All right. So next, I'm going to be talking about standard deductions versus itemized deduction. All right. For 2021, if you are single or if you file separately as a married person, your standard deduction is $12,550. If you are filing together with your spouse, your standard deduction is $25,100, which is a few $100 more than the year before, 2020. It's not a whole lot more, okay? And then if you're a head of household, it's $18,800, okay? So when do you want to take a standard deduction? You want to take a standard deduction when your itemized deduction here is less than these numbers that I just mentioned. Okay, 12,550, 25,100, 18,800. Okay, now what are itemized deductions that most Americans, or should I say legal residents, have? Medical expenses, which is subject to a 10% AGI limitation, which is a little bit more complicated, but just remember that rule. Number two is state and local taxes. And state and local taxes is limited to $10,000. So whether you decide to use sales to use tax, real estate tax, DMV fees and all of that, you are limited to $10,000. So for those of you who live in a higher income tax states, such as New York or California, you're out of luck. Because I know in the Silicon Valley, people could be paying $20,000, $30,000 in real estate tax. Unfortunately, only $10,000 of that is being a tax write-off. Okay, you could also deduct your mortgage interest as well under this method of itemized deduction. And then number four that I've seen most often is the charitable contribution. So you give away money to nonprofit organizations such as the Red Cross, the Salvation Army, the Goodwill, so on and so forth, okay? These are four typical itemized deductions that I've seen so far for most of the returns that I've prepared, okay? So let's just say you have medical expenses, which is subject to the 10% AGI limitation, and you have state and local tax. SALT stands for state and local tax of $10,000, and your mortgage of say $6,000, and then you give away $4,000 of cash to your church. Okay, so $10,000 plus a mortgage interest of $6,000, a charitable contribution of $4,000. So your total itemized deduction in this case is $20,000. Let's just say you did not meet this medical expense 10% limitation, AGI limitation. Okay, very rarely do I see my clients meeting this limitation. Okay, 10% of your AGI, anything above that would be a tax write-off. Any medical expenses below that 10% then it's not a tax write-off, right? So very rarely, unless you have a major medical surgery or medical situation, most people do not even qualify to deduct the medical expense here under the itemized deduction. So let's just say for this couple, they have 10,000 of state and local tax, 6,000 of mortgage, and 4,000 of charitable contribution. So their total itemized deduction is 20,000. Okay. Now you compare that 20,000 with this standard deductions of 25,100. Which number is higher? This number, right? The 25,100. So therefore, the tax laws will allow you to use this 25,100 on your tax return, even though under the itemized deduction method, you only have 20,000. Does that make sense to everybody? All right, there are some extra perks here. Now, if a taxpayer, if you are over 65 years old and blind, or if you are blind, you can get an additional standard deduction of $1,300. In this case, 1,350. Okay. Or if you are filing as a single person, or if you are a head of household, you could use 1,700. Okay. Alrighty. Now, if you are over 65 years old and you're blind, you get to double that $1,300 deduction. In this case, it'll be 2,700. I have a client who actually every year gets a letter from his physician certifying that he's legally blind so that he could qualify for this additional standard deduction, which is cool. I mean, it's not a whole lot, but every bit helps, right? So here's an example of what the 6-step process looks like. So you start out with your gross income. In this case, this particular client has some interest income, some dividend income, some pension income, and she's also taking Social Security benefit. She's running a business that generates a loss, a small loss, about $2,000 loss, and then some capital gain here. So her total income is $53,000. $53,253. So this is her AGI, 53,253. And then here's the itemized deductions, 6,000. Okay. But instead of using her itemized deduction of 6,000, we get to use 27,000 here. This is for 2019. Okay. And let's go back. Okay, so that's that. Pretty simple, right? Are you tired yet? Are you like totally confused? I don't know what Susanna is talking about. All right. So before I get into the detail of tax brackets, I want to again reiterate the difference between tax planning and tax reporting, just so this is a very brand new topic. Okay, so I hope you don't mind me keep repeating this every episode. So that is kind of like get you into the mode of thinking tax planning, tax planning, tax planning for 2022 and beyond. Okay, so what's the difference? The difference between tax reporting versus tax planning is this. Tax reporting is what you do every single year. Every April 15th, you report to the government how much you made in the previous year and what happened and how much in taxes you owe. It's a 6-step process, as I just showed to you. That's tax reporting. Now, tax planning is basically an act of intentionality. It causes you to think about what you need to do to minimize your taxes by utilizing tax laws, okay? So you basically make changes in your situation such that it will fit into the tax laws and it's 100% legal. You're not abusing any tax laws. Now, let me distinguish between tax abuse or tax shelter. There are a lot of people and companies out there who would sell to you tax shelter. They call it tax shelter, tax planning ideas that would reduce your income tax. Okay, and those transactions are being classified by the IRS as tax shelter, meaning that they are very controversial, that may or may not be approved by the IRS. What I'm going to be talking about is pretty much plain vanilla. Okay, like how do you convert your IRA into a Roth in such a way so that you are not paying more taxes because you didn't know any better. And that's not tax shelter. That is not tax abuse. I hope you understand that, okay? And take comfort knowing that what you're learning in this channel is to help you reduce your taxes legally without being classified by the IRS as a person who abuses the tax laws or a person who utilizes tax shelter transactions, which are totally something that you don't want to get into. Does that make sense to you? Okay. So I call tax reporting is a reactive way of handling your taxes. And I call tax planning is a proactive way of handling your taxes. Okay. And everybody is equipped to do the second way. Okay. The second way, which is to proactively manage not only your investment portfolio, but also your tax rate. How do you create a tax situation that would utilize the tax laws, but at the same time, not breaking any tax laws? Does that make sense to you? Okay, so you got to be working with a professional, a CPA, a tax CPA, and you want to make sure you work with a tax CPA, preferably somebody who could represent you in front of the IRS or who is an enrolled agent. They know a lot about tax laws. Or you may work with a tax attorney, or you may work with somebody who has a master's in taxation because that's their specialty. They really zero in to the tax laws. Some CPAs would do audit only, and that's their specialty. They do audits, or they do management consulting work. For example, they don't do taxes, right? So you've got to be careful about what kind of CPA or tax prep person that you're working with, depending on your situation. Let's just say if you're just a husband and a wife, a married couple with a kid, a house, right? A very plain vanilla. Maybe you don't need to work with a professional like us, an enrolled agent or a CPA or a tax attorney. You can just like go to Costco and buy a TurboTax program, and it will walk you through each process, each step, and it's very accurate, I would say. But let's just say when you start renting out your room for Airbnb, or let's just say if you have lots and lots of stock transactions. Nowadays, people get into cryptocurrency and all of that, right? It's like a hype, right? Everybody's into cryptocurrency. Then you may want to work with a tax professional to help you along the way. Because as you can see, every single year, you need to at least read 28, 29 pages of new tax laws or new tax information coming from the IRS. So who would have the time, right, to keep up with all these new changes? So at any rate, why is tax planning extremely important? Because we over here at InnoCham care about your wealth bucket. You know, as you can see, as you are out there busy working, generating income, like multiple sources of income, rental income, dividend income, interest income, investment income, what have you. All of your money will go into this bucket. Now, unfortunately, because you do not have the right professional on your team who can help you manage your bucket, well, guess what? Your bucket has holes. That means maybe you might be paying too much in taxes, or maybe you don't have a financial advisor who could advise you on different methods of investing your money, right? You do not manage your market risks very well. Or maybe some of you who are more conservative, who leave money under the pillows, under the mattresses, or you guys dig a hole in the backyard and you keep your money there. Well, guess what? Now your money is subject to this risk right here, inflation risk. Okay, inflation this year has hit like a 40-year high. Never have we got this much inflation in 1 year like 2020, 2021. So therefore, if your money is not growing at that rate of inflation in 2021, you're not winning the money game, okay? I also talked about debt and opportunity cost, long-term care here, which is another one which most people don't talk about as part of their retirement planning, which I will talk more. Most likely, I'm gonna bring a professional who know more about long-term care to talk to you about that. And then this part right here, interest, is not something that most people think about, but I would encourage you, my audience, to think about how much interest you're paying to the bank and to different people when you have a need to borrow money to do your stuff, right? Because if you know how to handle this well, then you get to keep more of what you make, and it will help your family financially long term. All righty, so as far as tax game goes, like I said before, the tax code is quite complicated and lengthy. As you can see, over the past 70 years or so, we started out with about 1.3 million words in our tax code, and it is now 10 million words. And this is as of 2015. Now, as you know, in 2018, former President Trump signed into law a brand new tax laws, okay? So added to that a few million more words. And then Congress is now working to change a few provisions in the tax laws. It's not finalized yet, but it's being worked on right now. So who knows? Maybe in another 50 years, this 10 million word tax code will turn into a 20 million word, I don't know, like 50 million words, right? So it's only getting more complicated and not similar, unfortunately. But don't you worry, because we have tax professionals who are here to help you. And if you want to learn to do it yourself, okay, you can follow this channel, subscribe, like, and share. And then we update this channel with new information all the time. Now, for those of you who just want to kind of do like a IY kind of thing, okay? When your tax situation is plain vanilla, you don't have any investments, so on and so forth. Okay, so big picture. Tax bracket, because we're talking about tax bracket today, okay? So as you can see, the blue line here from 1920, right? The tax code started in 1906, okay? But let's say from 1920 all the way until 2010. You see how the blue line goes down and then it goes up a little bit here. And then it went all the way down and then it went all the way up right here. Okay, and it went down and then it stayed flat for 1 decade or so in the 50s. Then it went whoop down and then went up and it went down and then it's kind of stable for another decade and it went down and then it went up. And then we're now in the period of pretty much, I say, stabilized. We don't know what's going to happen next. I mean, it could be, there could be another dip down and then it may go up again. But as you can see, in the US, throughout the history of the US tax code, we don't have like a flat tax, right? Depending on what the government wants in terms of revenue via taxation, they will change the tax laws, okay? And depending on who's in the White House and which party is in control, this line right here, blue line here, it may go up or it may go down, okay? So as far as tax planning goes, there's only so much you can do or you can manage, okay? But if you go to the White House website, whitehouses.gov, you're going to be able to pull up the budget for the country. And you're going to know exactly what the government is thinking, what it thinks is going to be the revenues for the next 5 years, for the next 10 years, who's going to be bringing in more revenue income to the government, right? So once you understand and you have this knowledge, then you are in a better position to manage your family wealth. Now, the red line here is the capital gains tax rate. Now, as you can see, it pretty much mirrors the blue line up here, okay? When the blue line goes up, right here, it actually capital gains goes down right here. My apologies. But as you can see, I mean, holistically speaking, do you recognize the fact that capital gains tax rate has always been lower than that for ordinary income tax rate? I mean, do you recognize that? I mean, do you realize this? This is the reason why you, for those of you who are not familiar with taxation, you've always heard about this. Oh, Warren Buffett actually pays less in taxes than his secretary. How is that possible? These rich people, they must cheat the tax, right? The tax laws. They are cheater, they are no good, that this, that. But little do you know that most rich people, they earn their money from this, from capital gains tax rate. Let's just say they have a lot of investments, and if they want to eat or they want to go on a vacation, they would just sell the investments and take that money and go on vacation. Well, guess what? It's the same money, it's cash, but now if they make $100,000 selling stock, well, guess what? That $100,000 is going to be taxed at a lower rate than if they were to go out there, get a job, a W-2 job, and pay an ordinary income tax rate of, say, 25% or 30%. Does that make sense to you? I hope so. Okay. So this is just to give you like an overview of why rich people, they pay less in taxes, because most of their money is derived from this, from capital gains tax rate, not ordinary income tax rate. So now if you want to change your family situation, financially speaking, you want to build wealth, you want to give your kids an advantage, financially speaking, right? I mean, America is the land of opportunity, right? The tax codes are written like that. And now you understand it. What are you going to do? How are you going to plan your family financial in such a way that maybe your kid and your grandkids and your great grandkids, when they need income to live on, maybe take advantage of this instead of them going out there and get a W-2 job. I don't know, I'm not saying that they shouldn't, but recognize the fact that there are two distinct tax rates. One is for capital gains and one is for ordinary income. Okay, it's very, very important. Another big picture. I'm almost done, everybody. So from 1910 to 2018, this is where it stopped, okay? As far as marginal tax rate, the highest and the lowest, okay? This is how high it has been, almost 100%. And this is how low it has been. At some point, it's almost like zero. You see? So the tax rates, even ordinary income tax rate, fluctuate. As you can see from history, I'm not making this up. I mean, I got this straight from the internet. I'm not sure where, you can just Google it, marginal tax rates in the United States, and you're going to see this table, okay? So as a financial person in your family, you're in charge of your money. It's extremely important for you to understand this. Your tax rate, even if you get a W-2, will fluctuate. It will not stay constant forever, okay? So just keep that in mind. Nothing is fixed. And the reason I bring this up, ladies and gentlemen, is because a lot of the time, I see a lot of gurus out there on TV and maybe on YouTube, right? They always talk about, oh, you should do this kind of tax planning for your retirement, this kind of tax planning when your kids grow up and go to college and all of that. They always say, well, when you retire, you're going to be in a lower tax bracket, so on and so forth. Well, nobody can guarantee your tax rate in your retirement is going to be low. What if, okay, on hindsight, okay, let's say if you were born around this time, okay, and in your retirement, the tax rate were over here. Then whatever that person, that CPA or that retirement specialist or that's, CFP or CPA, whoever, right, advises you that, hey, look, in your retirement, the tax rates are going to be lower. That's not accurate at all, because like, as you can see right here, I'm not making this up. Let's say if you happen to, be born in 1910, okay, and you retire in 1941, well, guess what? If you were to listen to that same advice back then in your 20s, right, you go, you know what? I think in my retirement, my tax rate is going to be lower. It's going to be like this, right? Then your whole planning is out the door, because now you're paying this much in taxes. You see what I'm saying? So like when you hear professionals out there talking about this, you have to be like critical and show them this, because nobody can guarantee you when you retire, the tax rates that you're seeing today in 2021 will be the same 30 years from now, 40 years from now. Nobody has a crystal ball, okay? I'm sorry to tell you a very sad news, but nobody can. What if in 40 years, the tax rate will go up again, like it happened before? You see what I'm saying? It happened before. It could go down, yes. Who knows? It could go up, it could go down, but to even, a professional to say that, hey, you know what? In retirement, you expect to have less income. You expect to be in a lower tax bracket because look, this is what the tax bracket for lower income people nowadays. I don't think that is right. And that's the reason why I'm creating this channel to inform consumers, to taxpayers, especially Americans out there, to learn about this stuff and then think about how all of this fits into your retirement planning strategy, okay? And to end this presentation, I have only 2 more slides and we're gonna be done. Here's the big picture individual income tax bracket for 2021. I hope you like the colors. I love these colors. I think they are very pretty, but for those of you who don't like the colors I use here, please forgive me. Tax rate, 10, 12, 22, 24, 32, 35, 37. 1, 2, 3, 4, 5, 6, 7. 7 brackets, just like what I said earlier in the presentation, okay? Now determine what your filing status is. Are you a single person? Are you a married person? And you file jointly with your spouse. Or are you a married person? You file separately from your spouse. Or are you a head of household? Okay, so if you're making $9,950, you pay 10% in taxes. What if you make less than that, less than 9,950? Well, you are still in a 10% tax bracket. Makes sense? Okay, and this is taxable income, okay? This is not gross income. All right, now, if you're a husband and wife and you file joint together, both of you, if your taxable income is $19,900, then you pay 10%. If each of you file separately, then you pay 10% if your taxable income is $99.50, very similar to the single tax table, right? And then of course, if you have a child or if you support somebody and therefore you are considered a head of household, the definition of head of household will be explored later on during the season, okay? But let's just say that you're a head of household. Then if your taxable income is $14,200, then you're subject to a 10% tax rate, okay? Now, you're gonna get into a 12% tax bracket if you make between this much and this much, if you're single, your taxable income, okay? I'm talking about taxable income, not gross income, taxable income. So I think this is very clear to everybody, right? So let's just say if you make more than $523,600 and as a single person, you know you are in a 37% tax bracket, but it doesn't mean you take 37% multiplied by 523,000, okay? The first 9,950 is subject to 10%, and anything between this number, the 9951, and the 4525 is subject to 12%, right? So you gotta do this calculation for every level of income until you hit 523,600, and whatever above that is multiplied by 37%. Does that make sense to everybody? All right, Last but not least is the capital gains tax brackets for 2021. So for capital gains tax brackets, there are 3. You are at a 0%, 15%, okay, and then 20%. Now, let's say if you're a single person and your total income, including your capital gain income, is less than $40,400, then none of your capital gains is subject to taxation. Does it make sense to you? So let's just say you have income, W-2 income of $20,000, and then you sell some stock, and let's say it's a long-term capital gain. Okay, long-term. So you have held a stock for more than a year, you sell it, and you get a $20,000 gain. Okay, so $20,000 of capital gain, long-term capital gain, and $20,000 of W-2 income. So your total income is $40,000. Okay, so how is that taxed? The $20,000 capital gain, long-term capital gain, will be subject to 0% tax. The other $20,000 of W-2 income will be subject to this much in taxes, 12%, right? The first $9,950 is subject to 10%. And then the next, I say 11,000 is subject to 12%. So your blended effective tax rate is probably about maybe 10.5% tax rate. So if you're making income like that, so now you understand why you want to invest, right? You want to get income from your investment, because if your income is under 40, let's just say in 2021 you didn't have a W-2, you have no salary, and all your income is basically investment, long-term investment. So maybe you bought Apple stocks 30 years ago or something, right? And you decided to just take a break in 2021. So you start selling Apple stock just to live off of your Apple stock. Well, guess what? You'll be making $40,000 of capital, long-term capital gain, okay? And you pay 0 income tax. Isn't that beautiful? Yeah. Don't you wish you started to buy Apple stock 30 years ago? Right? And now you're in your retirement. And if you live in a state with 0 income tax like Florida, okay, if you make $40,000, you could live very, very comfortably in Florida with $40,000, and you get to keep all of it. Make sense to you? Okay. So now, if your total income is up to $445,850, then the portion of your long-term capital gain tax will be subject to 15% tax rate. And then, of course, if your overall income is more than $445,851, then the long-term capital gain tax rate for you is 20% if you're a single person. Okay. So what does this tell you, ladies and gentlemen? What does this tell you? The highest capital gain tax rate is 20%, whereas the highest income tax is 37%. Now you understand why Mr. Warren Buffett actually pays less in taxes than his secretary, right? So to end my presentation today, I'd like to end it with another joke. My son wants to pursue a career in blackmail and larceny. I was wondering if you folks here at the IRS had an intern program. Isn't that funny? It's a joke, everybody, it's a joke, okay? I hope that puts a smile on your face, and if you have any questions, please email me. Here's my email. You can also email us at WeSaveTaxes@gmail.com as well. And go ahead and check out our website at innocham.com. If you want to know more about me, you can go to LinkedIn. I have my resume and my professional profile there. It's extremely professional environment. So I get recommendations from professional people who have worked with me in the past. Totally reliable. And I hope to share with you additional tax knowledge again later on during the season as well. And feel free to send us an email for any topics that you're dying to know and nobody could answer you. Hopefully we'll be able to help you out. Okay, until next time, have a wonderful week ahead. Bye-bye.